Good morning and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi, and you thought the stock market was closed this week because of the New Year holiday. Newsflash, it's not. That's why I'm here. So here's what's on my mind right now. If the hot AI trade is cooling down, I am not seeing it. In the past month alone, we have seen Alphabet shares hit fresh records. NVIDIA has plunked down $20 billion to buy AI chip startup Grok, and startups keep raising large sums of money. Chew on this one, friends. Silicon Valley's hottest startups have raised $150 billion in funding this year, according to new data from PitchBook. This has crushed the previous record high of $92 billion raised in 2021. Naturally, Wall Street is staying bullish on the sector. In a new report titled 2026 Year Ahead, Choppy, Still Cheerful, Bank of America's semiconductor analyst Vivek Arya forecast a 30% year-over-year surge in global semiconductor sales that will finally push the sector past a historic $1 trillion annual sales milestone next year. His top picks include NVIDIA, Broadcom, Lam Research, KLA, Analog Devices, and Cadence Design Systems. While this pure AI trade is playing out, investors have expanded their view on AI winners to industrial metals. Silver touched record high today. Same goes for copper. Both of these metals are key players in building out AI infrastructure in this country and are in short supply. So is this bubble activity or just good old-fashioned growth mode stuff for AI? Here in the Opening Bid Roundtables, Adam Coons, Winthrop Capital Chief Investment Officer, and we have Yahoo Finance Senior Reporters Brooke DePalma and Nez Ferre. Good to see you both. Nez, let me start with you because you've been really fired up this morning on all things industrial metals. Set the scene for us. What are investors seeing?
Yeah, look, with the industrial metals, investors are seeing that there is this talk about demand when it comes to silver, when it comes to copper, when it comes to the industrial uses of these metals. And you even had Elon Musk over the weekend tweeting about the industrial uses for silver. There's been a lot of concern about silver because it was put on the critical minerals list in the US, and also China is going to be restricting exports of silver starting in January. And this was announced back in October. You've seen silver prices that have been steadily going higher and higher, going parabolic. On Friday, silver going up by more than $10 in one session. It also was in backwardation. That means the spot price for silver, the silver delivered immediately, was higher than the futures price for silver. So that's causing a huge amount of concern about the market and the tightness and the supply tightness that you're talking about, that traders have been talking about when it comes to silver. Yet it is a very parabolic move. It is a move that is very fast, very quickly, and you have had some strategists warning about this move because both silver, by the way, and gold are on pace for their best year since 1979. And back then, when you saw these types of parabolic moves, you saw a peak in 1980, and then you saw the metals crashing afterwards. So there are strategists that are saying, take profits, watch out with this fast move that you've seen in these metals, in the metals market.
Adam, good to see you here this morning. Let me get you into this precious metals debate. Do you go in there, do you enter the bubble, do you just close your eyes and just pray and hope for the best, or do you follow some of this cautiousness that Nez is talking about?
Well, I think you got to separate a few different things here. Some of the moves in gold and silver kind of behind it are driven a lot by what's happening with the U.S. dollar and some kind of just flows of liquidity. So you've got more than one factor here. And now with some of the more industrial metals, I think you want to stay in there. I think, when you're looking at, the AI trade, I agree with kind of how you started. That trade isn't fading as a whole. There are obviously certain names and pockets that are, but for us, what we're looking at are just that. Just what are the components within the supply chain, or just overall within AI that kind of can benefit from the growth in AI, because I don't think anyone is really denying that AI is a real thing that's here to stay. It's just who are going to be the winners and losers. And so, when you're looking at industrial metals that play a part, like copper, we still like that. Now, when you're looking at these parabolic moves in silver and gold that have some correlation to the AI trade, but I would argue it has more to do with Fed policy, dollar policy. So that's the area that I'd be a little bit more cautious.
Adam, what's the best course of action for the average investor? Do they waste a whole day trying to find the next big play in AI, or do they just say, you know what, NVIDIA's going to win this whole damn thing, I'm just going to bet on them again next year?
Yeah, I definitely wouldn't just bet on NVIDIA. I think you do need to do your homework if you want to buy specific names. I think probably the general investor is probably better finding some sort of basket to kind of play the overall space. But we're very early innings in this, and obviously NVIDIA is the winner right now. But to say, in 5 years that we look back that they're going to be the dominant player still, very, very unlikely. Like I said, this is really an evolving space. So I would be careful with something that's so specific as NVIDIA. We kind of like to barbell this with, something like the big hyperscaler, like an Alphabet, Google, because that's really the type of name that you could probably have a little bit more comfort in, because they just overall, the AI story is just benefiting an already existing business model that was doing well. So I think you would just want to be careful with what we're calling kind of the one-trick ponies, like a NVIDIA, a CoreWeave, or a Palantir right now.
Brooke, let me get over to you, because I think what you're seeing in industrial metals and some of the things that Adam's talking about fits nicely what we heard from Ed Yardeni this morning, that he might see, we are likely to see a broadening out in this rally. Investors doing their homework, trying to get outside of the tried and true Mag 7.
Yeah, Brian, what we did hear from Ed Yardeni over the weekend was really ongoing momentum in this market in 2026. He maintained that year-end target for the S&P 500 of 7,700. And he said largely it won't be really led by the Mag 7, but also what he called the impressive 493 of the S&P 500, as really this broadening out, this boost in productivity growth really leads to overall returns for the S&P 500 in 2026. Specifically, he went on to say that that is really where exactly investors should be thinking about this mindset. Not really overweight technology, but more so thinking about the other users of AI as opposed to just the producers of AI. And so certainly he's not alone in this momentum that he thinks will exist within 2026 ongoing from what we've seen so far in the returns in 2025.
And as I've been wasting a lot of my own personal time and thinking about who else will be the AI winners, I really don't have anything else to do at this point in the year. And I'm stumbling upon a company like Exxon for obvious reasons. Exxon stock has had a really good year. It's something not a lot of people have been talking about, and that comes alongside oil prices going lower. So are oil stocks the next AI play here, or am I just reading too much into it?
No, I mean, there's certainly a group of strategists that are talking about that you will be seeing commodity prices when it comes to oil going higher eventually. But you also are looking at natural gas that's been going higher. Natural gas is really the play. That is going to be the winner as far as the energy spectrum is concerned, or the energy players are concerned for AI, for data centers. And I took a quick look at the components in the S&P 500 that have done very well this year, that have beat the S&P 500. GE Vernova, they make gas turbines. They also are in the services business. That stock is up 100% year to date. You've got NRG Energy, a power company, up 75% year to date. Constellation Energy is also up. You even have Albemarle, the lithium maker, that is also up year to date, 76%. Because guess what? You also need a storage of energy, and lithium is used in battery packs. So there are a lot of other players within the AI space, and especially when we're talking about energy and upgrading the grid and all the energy that AI is going to need.
And I don't know if I asked you this, you watching that Landman show on Paramount Plus? I mean, that's a good show.
I have not been watching it because I just don't have time, but I've got to get on it.
No, it's good. I think their current episode, they are drilling for natural gas out in the ocean. Just a fascinating stuff. Adam, let me get back to you. What are some of your top picks for next year and why?
Yeah, so like I said, looking at kind of a barbell approach, we still like Alphabet going into next year, and we still like Microsoft. So those are kind of the big behemoth hyperscalers that we still like. And then, down the chain, we like I said, the things that overall the AI story will help prop up. And for us, it's cybersecurity becomes more and more important. So they've obviously done really well, but Fortinet, CrowdStrike are two of our top picks on the security side. So like I said, we're trying to play it with big hyperscalers with, very robust business models, and then down the chain, just having a smaller position size. I think you want to be really careful with position sizing, but we're building a basket of, like I said, smaller names. Reddit is another name that we like within kind of, it plays into the AI story, but is much smaller. So the position sizing is done accordingly. But so that's kind of our approach right now is the hyperscaler matched with some of the very specific, kind of one-off names.
Adam, when you're crunching the numbers on some of these names, like a Microsoft, Alphabet, even a Reddit, they're all valued at a premium to the broader market. Are you willing to accept that these above market multiples if these companies are still in high growth mode? And they really all are.
Yeah, this is one where you got to be careful. I think, valuations are something that can get disregarded, and then suddenly they kind of become the narrative when they get a little bit stretched. But stocks don't go down because valuations are stretched. They go down because that valuation just starts to erode the margin of safety. So, like I said, you just have to be cognizant of that. You need a position size. So as valuations kind of get a little bit more stretched, you want to be a little bit more careful, sure. But that should not be a cause for you to sell a stock outright unless there's just something in your model that just tells you should fundamentally. But stocks can grow into their valuations as well. Just because the valuation is a little bit on the high side, maybe the stock slows down, it doesn't accelerate the way it has, but it doesn't mean that it has to go down. Like I said, the one thing to be careful about when you see valuations get kind of at their upper bound is just the margin of safety is smaller. So you just have to be more careful, and earnings miss, something like that will be more painful when valuations are stretched. But like I said, it doesn't mean the stocks are going to go down.
Brooke, last word to you. I was thinking about where else could the rise in precious metals hurt companies? And I look at a company like Signet Jewelers that obviously owns a lot of the metals. Like we go to their stores, K Jewelers, we see all the jewelry. I really wonder, the price increases they might have to take just to offset some of the higher costs of their inventory.
I mean, Brian, forget about the typical jewelers. Think about a company like Costco. They were selling those gold bars back in 2 years ago, and they were priced around, say, $2,300. And now think about where gold is today, nearly double that. And so you think about these different retailers who really put out this proposition, take Costco, but also take those jewelry companies. Certainly what this could mean end game here is higher prices for consumers. They'll definitely be paying that to sort of meet and compete, or rather go up against where exactly we are now within silver, copper, and gold. Also, I'm thinking about, the build out of the return of the housing market as well. Copper, obviously a key component of the housing market when you go to do renovations and things of that nature. And so this end game here really does mean higher prices for consumers at the end of the day, and maybe not a traditional mindset that you have when you think about, the build out of just AI data centers and all the needed materials for that, but certainly how that then trickles into everyday costs for Americans as well.
I think Inez purchased some Costco gold bars with her pizza. Inez is a big fan of that Costco pizza.
I love that Costco pizza. I always get one.
A big thank you to my opening bid roundtable. Happy New Year to you all. Appreciate you bringing the heat on this Monday morning. Straight ahead, a lot of what will happen in markets next year hinges on the Federal Reserve. I'll have a chat with Apollo Global Management CEO Mark Rowan on this very topic next. Federal Reserve could be full of market volatility inducing drama next year. The Fed could be more divided, something that has played out in recent months. And we will probably know soon who President Trump has chosen to replace Fed Chair Jerome Powell next year. I sat down with Apollo Global Management CEO Mark Rowan to get his perspective on all things Fed.
Internally at Apollo, we do not think there's a need for a cut. There's nothing in the data that tells us, but at the same time, I understand the decision. But longer term, I'm not sure it really matters. I mean, if you think about what's happening, the market is ultimately determining the outcome. We have governments around the world who are borrowing record amounts of money. We are, for maybe good and valid reasons, fractionalizing our labor supply through immigration reform. We're fractionalizing our flow of goods through the other tariff and other measures, again, for good and valid reasons. Those things tend to be inflationary. And so a lot of what we're doing is inflationary. Certainly borrowing lots of money has the potential to be inflationary. Depreciating our currency has the tendency to be inflationary. And what we're seeing is a steepening of the yield curve. Rates that matter, the 10-year, are higher, even if short rates are lower.
What do you think the impact will be if we do in fact get another rate cut, and if the Fed does embark on maybe one more next year?
I'm not sure. This is what's priced into the curve. I think at the end of the day, the short-term fluctuations of monetary policy, interesting but not all that relevant. It's ultimately about maintaining the confidence of the financial system and of the bond market, given the scale of borrowing that we and other Western governments need to do.
It's interesting to hear you say that we don't need another rate cut. And Powell, of course, has access to so many. You own so many amazing businesses all around the world. What are you seeing in terms of the economy? Because GDP has slowed, jobs have slowed. So I think the market wants a rate cut.
Slowed from what?
Yeah.
What's normal? We've gone from a period of time of COVID to massive stimulus to tariff shock. Tell me again what's normal? I don't know that we see normal.
Like 2.5% maybe?
Things feel pretty good. And by the way, growth has been in that range, if not higher, from various points in time. Unemployment is at numbers that historically we used to call full employment. We also have mixed signals. We don't have as many workers. We therefore may not have as many jobs. It appears to me in our companies that things are just fine.
I really enjoyed an op-ed you wrote recently on private markets. You've been beating the drum on this. You gave a really good presentation at Goldman Sachs today on this. What are some things that people are not understanding about private markets here?
Well, I think there are two big things that I've really focused on. First, the definition of private credit. In much of the financial press, private credit means levered lending, a below investment grade deal-related activity. And the reality is most private credit is investment grade. And most of the credit in the financial system that is private, banks, insurers, pension funds, is investment grade. There's a whole discussion about what private investment grade is and why it exists, but its competition is public investment grade. And generally, it has outperformed public investment grade, both in return and in safety. Put that to the side. Much of the press is focused, as I said, on this notion of levered lending. The levered lending, a below investment grade activity, comes in two flavors. One flavor is the broadly syndicated type, which is typically underwritten by banks and then distributed. The other is that which is underwritten by asset managers and is typically held and is sometimes called direct lending. The big miss there is it's just an investment. It's like a stock or a bond. We don't think anything of NVIDIA or the S&P going up or down 10 or 15%. And yet, one private credit loan or one broadly syndicated loan defaults and people lose their mind. Why are people investing in levered lending? They're investing to reduce risk. Generally, what investors are doing is they're taking money out of equity or out of high yield bonds and moving into levered lending. It's roughly the same return and it is less volatile. And if you hate levered lending, you're really going to hate high yield. And if you hate levered lending, you're really going to hate equity. This is a de-risking activity, and it is mostly conducted by investors who are seeking to de-risk. And I just leave it there. We could go on all day and just talk about private credit.
When we saw some of those, the pressures from Tricolor and First Brands, why do you think that really didn't spill over into the broader stock market? We saw some convulsions, but it wasn't like that worrisome moment.
Why should it be? Companies default all the time. I mean, there's in some of the materials that we will put out later today, you'll see 20 years of defaults in the investment grade market, the levered lending market, and the high yield market. Well underwritten credit, even if it defaults, usually has very strong recoveries. The notion that something defaulted, okay, it defaults. The question is, was it a sign of something wrong in the economy? The answer from my point of view is no. This was just sloppy underwriting. In both those instances, the warning signs were there, it was avoidable. And by the way, both were underwritten in the banking system in the form of broadly syndicated loans. Forget that was not direct lending or asset manager driven direct lending. That was a factoid that people just didn't need.
I love this quote by you at the Goldman today. Great fortunes will be made and lost in data centers. Explain that to us.
Well, we were talking about the notion of financing for data centers. And the point I was making is that as a credit investor, you want to get paid back before you get to renewal. Because it is very clear today and for the next few years that the demand for data is unbelievably strong. Therefore, for the next period of time, based on contracts going in today, we should have very safe cash flows in which to amortize credit. Ultimately, the return on equity, though, is a function of renewal. I have a chart on the wall in my office, which is just about energy usage in the year 2030, not that far away. And each of the good and the great consulting firms have weighed in, and it looks like a child's scattered dart plot. The fact is, if experts looking out not all that far have no idea, we are making a fundamental bet on equity. And that bet is driven by technology, it's driven by chipsets, it's driven by energy usage, it's driven by quantum computing, and a whole host of factors that we are not yet considering. So I think as equity, people should be allowed to take that bet. Great fortunes will be made, great fortunes may be lost. We, in fact, are investors in data center equity under the right circumstances, in the right way, for the reasons that we believe we will get upside. But I don't think it is a foregone conclusion that because you own a data center and you own equity in it, and data is valuable, that you will make money in data center equity.
I didn't want to be that guy to ask you about a bubble, so I'm going to ask it a different way. Are you concerned by how much debt some of these tech companies are taking to fund their AI ambitions?
I'd say concerned, I don't know. And I think tech companies is a broad term. For the most part, the hyperscalers are the largest and most successful companies that exist, not just in the US and worldwide. They have massive amounts of cash flow coming from lots of other businesses. And if I am worried about the debt of hyperscalers, the economy and the US have way bigger issues. So generally, I am not worried. But there's a whole series of intermediaries who are large owners of data capacity, who themselves are not in other businesses that afford them the luxury of using their credit rating and balance sheet to make massive commitments. And those companies essentially are the equity owners of data centers. Levering those companies, given my previous comments, does not seem to be the safest thing I've ever seen.
We'll have to leave it there. No new toys. Is that still the mantra?
Oh, that's old news.
That's old news? Okay.
Our business, in fact, our industry has been going through just massive amounts of change. We've gone from a business that historically had one market, the alts bucket of institutional clients, to now 6 markets. What is needed to serve those 6 markets is different than what was needed to serve just the one. And so we and our peer set are evolving our businesses based on how we each individually see the market developing, and we don't all see it the same way, which is what makes it fun.
Coming up, Jared Blickery has you covered on market catalysts. We'll be right back.